Hey everyone, fantastic. So thanks very much. It looks like everyone can see, the slides are fine. Just go through our disclaimers really quickly. The information and opinions in this report are for general information use only and not intended as an offer or solicitation with respect to purchase any sale of any sale of currency or CFD contract. Foreign exchange and other leverage products, they involve significant risks of loss and they're not suitable for all investors. Increasing your leverage increases your risk. Spot gold and silver contracts, they're not subject to regulation under the US Commodity Exchange Act. Contracts for difference, otherwise known as CFDs, they are not available to US residents because of regulatory reasons. And then the other thing I just want to show you guys, because I'll probably be looking at a lot of these today, we may use Bloomberg charts in this webinar presentation. Prices displayed on a Bloomberg chart might not reflect Forex.com prices. So that's the key thing to remember there. Okay, guys, let me pull up a chart because I do want to show you a couple of things. This one is the key one I'm looking at. This is dollar yen. It's a daily chart. The big blue line in the middle of it there is the 200-day moving average. It's not the exponential. It's just on the close. Very simple moving average there, and we are getting so close to that level now. It may be the non-farm payrolls day today. Just as a quick reminder, I'm sure most of you know already, but there will be no non-farm payrolls today because of the government shutdown in the US. And there seems to be no end in sight to it, even though there were some positive comments coming out of John Boehner's office yesterday, or at points yesterday. They didn't really end up turning into any action or any, breakthrough in this impasse in Washington. So Pan, I think you've said quite the right thing. What a bunch of morons. But basically what that's done, it seems more and more that a government debt shutdown will be dollar negative. And it's going to be very bad news, obviously, for treasuries. And I'll show you a couple of charts there. But obviously, that dollar negativity is being really felt in dollar yen. And just as this lasts, we're breaking some significant levels here. 96.65. 96.65, literally imprint that on your mind. That is a 200-day moving average. Now I've just put out a piece about dollar yen, and you can see it on our website at forex.com. It'll be up there in a little bit better, but do check that out. GAM, you seem to believe that they won't let it go past 17th of October. That's good. We all hope they don't, because remember, a government shutdown we've all been used to, but a debt, hitting the debt ceiling, that is uncharted territory. And, at first people have said the market has been very slow to price this in, but I think you do have to give the markets just a little bit of respite because they don't know how to price this in. This is uncharted territory. They have no idea how to price this in. So, that they haven't even really attempted it, but they are starting to attempt it the closer we get to that deadline. So, we're on the 4th now, so we're 14 days away. It could be an interesting couple of weeks, and if there's still no deal, I'd say by next week, by the middle of next week, we could really see some fireworks. But this is obviously where we're seeing it. We got to a low of 96.95 earlier. That also came on the back of the Bank of Japan meeting. So even though usually those of you who join me will know that, when you talk about non-farm payrolls, the immediate thing you have to look at is dollar yen, because it's just so sensitive to payrolls and changes in US monetary policy. But in the absence of that today, it doesn't mean dollar yen has been boring. It means we've just looked at the Bank of Japan meeting. They had a meeting today. They kept policy on hold. They didn't do anything, didn't announce anything new. We sorry, I can't even get my words out today. We got a press conference from Kuroda. The key things that he mentioned is current easing is probably enough to reach the price target. Japan CPI has turned positive. It will continue to rise. Easing is having an impact on financial markets. The Bank of Japan may ease for longer, but it will take less than 2 years to get stable inflation. And Abe's economic package is a big plus for Japan's growth. So 2 things I take away from that speech. Number 1, Kuroda seems happy with the impact of previous monetary policy support. And really the speech doesn't suggest that they're going to be in any rush to add more stimulus. He tried to jump on that forward guidance bandwagon of the BOJ may ease for longer, but essentially we're all focusing on the fact that the Bank of Japan now think that the 2-year inflation target is reachable. So that suggests they don't have to do any more stimulus, which is the end positive. Added to that, just reinforcing the fact the Bank of Japan is very much on the sidelines right now, not about to embark on new policy, is that the fact he mentioned Abe and the Prime Minister Abe of Abenomics fame. And he said that the economic package is a big plus for Japan's growth. It suggests that the Bank of Japan are very happy to leave the heavy lifting to the government rather than to them. So that's been a positive thing for the yen today. And we did get down to a low of 96.95, but we started to look very, very oversold on a short-term basis on the hourly. So we fell, so we've kind of bounced off there, but so far pullbacks have been very, very shallow. 97.20 is the daily pivot. That's actually thwarted things so far. Above there, you're looking at the 100-hour SMA at 97.70. And then the key resistance level to note is 97.95, which is the base of that daily Ichimoku cloud. Remember, as long as we remain below the base, that suggests that we are in a downtrend, so in a technical downtrend. Now, obviously on the support side from where we are here, it's at 96.65 level. This level here, that is huge, absolutely massive. A lot of people in the market looking at that, watch it. We'd expect it to be very sticky. And if we get below there, it's a real medium-term bearish development. So I think that, at the moment, what would it be that would take us below there? More than likely, continuation of what's going on in the US. Today's obviously going to be quite important. The weekend as well. The markets will be closed over the weekend, of course. If we get any deal, that could trigger a relief rally in the dollar. But if we don't, that's just going to increase tensions, we believe, and push things even further. Now, yesterday I sent out a chart. If you follow my research, just bear with me 1 minute. I really want to show you this, because a lot of people I've had a lot of these. I've had a lot of people asking me, clients and people that work here and other webinars from yourselves, why haven't we seen any real crisis? We're starting to see it in the last few days, but really where we saw it was here. This week has been really, really traumatic for those who are long, very, very short-term Treasury bills. So this is the yield on the 1 month bill, and as you can see, shot higher to its highest level since November 2012. Now that's significant because remember back in November 2012 what we would think about was the fiscal cliff. So there is panic in the market, and this is where we're seeing it. Likewise, the US CDS. Let me look at this. Do you remember CDSs? Cast your mind back 5 years, and that's when they really got their biggest kind of fame, if you like, was on the back of the financial crisis. CDSs were everywhere. Well, CDS is a measure of default risk, and let me US. Sorry. I know. Sorry, guys. Yeah, CDS, that may work. Yes. This is the US CDS rate as well. As you can see, that has shot higher to its highest level of the year so far. There are pockets of worry. We can also just take a quick look at the S&P 500. Because the S&P 500, as you can see, it fell through its 50-day moving average yesterday, and that is significant. It does suggest that there's bearish momentum now in the short term. Opens the way to this 1661 level, the 100-day, and then these lows here from the end of August, which come in around about that 1630 level. Has the VIX moved yet, Gam? Good point. So the VIX, those of you who follow my research as well, I put something out about this on Monday. The VIX, as you can see, it has pushed higher, but not massively so. We did increase above that 18 level yesterday, even though we haven't really moved in any significant way. I mean, we're still lower than what we were in June when we got to 22. So there are some people who believe the VIX isn't a very good measure of overall risk appetite. And also, you've got to remember as well, people may not be buying protection for their S&P purchases because for as long as this brinkmanship goes on in Congress, it really does mean that there's going to be a longer term or a longer period of QE. So we've already had some Fed members come out this week and say that the delay in the release of economic data, that's the key thing for the Fed right now, because their decisions are based on economic data and they don't have any economic data to analyze, which means that tapering is unlikely to begin in October. And if this carrot continues on, especially if we get some fears around this debt ceiling issue in just 2 weeks' time now, then we may not even see tapering until well into next year. Now, what's the other thing that we have to remember, of course, is over the next months or so, couple of weeks or so, probably by the end of October, we do expect the next Fed governor to be announced. Now, there are a couple of things in there. Obviously, if we get, Yellen is the front runner, but we think that if these fiscal issues do really escalate and we do reach that, that debt ceiling limit, maybe without it being increased, then what we could do, then what that may do is get maybe increase the pressure on Obama to actually re-elect Ben Bernanke for another couple of years, maybe or even just 1 year. Because remember, the market probably won't want someone new. So if Bernanke is in charge, obviously he's a bit of a dove, not that into tapering yet anyway, then it suggests more of the same, and that could potentially protect the downside for some risky assets. On that note, I want to show you something, just the dollar South African rand. And as you can see, it's quite stable. Now, obviously, it's still at elevated levels, so the rand is still fairly weak on a longer term basis. But we haven't really seen this kind of, massive shoot higher. We haven't got back to those record highs that we saw just in August. So, it does suggest that, even in emerging markets, which are usually very sensitive to external risk events like the potential of a US default, it's not really being reflected in the markets. And you've got the Fed, thanks for that. Now, Black Hat, interesting that we did get the unemployment claims out yesterday, but not NFP today. Yes, it is interesting, but there's a good reason for that, because they collect it Thursday to Thursday. So they actually put that together last Friday. Remember, because it was for the week prior. So that data, so the initial jobless claims data, that will be the only data that we'll get. For example, if this is ongoing, we won't get it next week. So that was the main reason why we got the claims data, whereas the NFP data would have been collected all the way up to Monday night. And there just wasn't the time to put it together. So that's the reason why. FX, Roy, you want First Word FX? Yep, we contribute a bit to First Word FX as well. Let me see if it's here. Basically, First Word FX is just scrolling news. So this is it. That is what First Word FX is. So it's more of a scrolling news thing. Obviously, in this environment, though, with scrolling news, with any type of FX news. I'll just show you my launchpad, actually, because that may be useful to you as well. This just shows you the things that I look at these days. It's a little bit of a mess today. Sorry about that. But basically, I have my prices here. So I'm always looking at my prices. But then here is my newspad, and it's FX mostly, but mostly the FX stuff is literally headlines that are coming out from either Europe or coming out of the US, depending on what's been going on. So that's kind of the at the moment, even kind of specific FX news, hardcore FX news like out of Bloomberg, it's still hanging off of Washington, hanging off of what's going on there. Now next week, obviously the focus is very much going to be on the US, but there are a lot of ECB speakers. And on that note, I'm going to look at Euro quickly. Because as you can see here with Euro, we're above 136. We've been comfortably above that level. We're looking very, very strong in the Euro here. Obviously, we had that ECB meeting on Wednesday because of the German reunification holiday yesterday. And that was, they didn't talk down the Euro. That sounds kind of a funny thing to be talking about. Obviously, back in February, remember that? They did talk down the Euro. So we made a fresh daily high yesterday. But an intraday high is still at 137.10 level, which was from the 1st of February, which is that ECB meeting. And after this ECB meeting in February, when Draghi said he wasn't comfortable with the level of the euro, it fell 800 pips. Now, the same thing, he didn't say the same thing this time. He sounded pretty much, sanguine. Black Hat, I think you make a good point. There is Berlusconi drama. Don't forget the fact that we may probably get the most controversial figure in politics, not just in Italy, but anywhere, actually expelled today. So it could be the end of Berlusconi. I thought it was quite interesting what went on with that Italian vote, just to digress a little bit, guys. But it really suggests to me that Italy's changing. Italy's not about single power, single person, single character politics anymore. You can see that in things like the Five-Star Movement, and that gives me real hope that we could see some political reform, could see economic reform. But yes, we could be getting rid of Berlusconi today. Obviously, the fact that Italy didn't collapse has helped to boost the euro and kept us comfortably above this 136 level. As I mentioned, though, I think the closer, those of you who join my webinars regularly will know that I feel that 136 to 137 is a bit of a line in the sand for euro. I would be very I'm still very kind of conscious that we may see a wave of selling pressure, and it could be driven by two things. Technical factors getting to that 137.11 or 137.10 if you like, if you want to round down from the high, the intraday high of the year so far. I think that could definitely attract some selling interest. The other thing, of course, is if we do get some sort of resolution, maybe over the weekend, then I think we could see a strong relief rally in the euro and in the dollar, and everything will be good again. So we could see the euro dollar reverse course quite sharply. Obviously, there's some very good support. I'm not saying it's going to fall through the floor. It's not just based on the dollar weakness that euro's been rallying. Euro's also been rallying on the back of a strengthening of eurozone data. We had PMIs out earlier this week. They were very strong. We saw unemployment, even though it's very high, it missed. It came in slightly below expectations, which is a good thing. And we saw very strong retail sales from the currency bloc yesterday. Now, everybody, watch out for our week ahead, because I'm going to be writing a little mini analysis on whether or not Greece has turned the corner. And obviously, if that happens, then that's good. I'm very, very interested to see your own chat box and Bunga Bunga parties come into that. Yeah, well, he certainly didn't just kind of retire into Bunga Bunga land. He's been, certainly trying to upset Parliament, but it does suggest that his, the antics of the last week from Berlusconi do suggest that maybe he's lost his grip on power. And it did suggest, the fact that he tried to topple the government was a bit like kind of the final throes of the superhero who's losing all his powers. He was just pressing the self-destruct button. And that certainly wasn't too helpful. But in terms of what this means for euro dollar, you're completely right. Italian issues. It's Italy. It's very rare that European politics look more, seem more progressive, look more, look less dysfunctional than the US. But right now, relative political situation is actually supportive of the euro rather than the dollar. So watch that there. And obviously in this environment, let's take a quick look at the dollar index. As you can see, not yet, any moment, dollar index is just looking so weak. So these fiscal issues are really weighing on dollar index. And again, if we don't see a quick, swift resolution, and the closer we get to that debt ceiling debate, it really is going to be, in terms of, what does that mean for the markets? Obviously, we think on a long-term basis, it would be bad news for the dollar, bad news even for treasuries as well. We could see a broader base, particularly the shorter end of the curve. So maybe that kind of, 1 month to 5 year range, or even 1 year, acting very, yields rising there. Obviously, further out the curve, that could just attract more safe haven interest. So that's quite interesting. We're already hearing that banks in the US are having emergency meetings every single day trying to plan for this. This is a big deal. And if the closer, the longer we go on for without a resolution, the closer we are at risk of reaching that 79 level, which is the low so far. A key, as you can see, 1, 2, 3 is hit there. A key support level. So below 79 is a very bearish development for this cross, and opens the way to even, potentially to these kind of lows from 2012, which came in around about just below 70, around about that 78, 70 level. So it's basically suggests we're in a new paradigm. As you can see, overall, this is a 5-year chart. Dollar is looking kind of weak within its longer term range. So there could be certainly be further downside to go. So there's definitely some levels there to watch. And obviously the cable has been a big beneficiary. Let's take a look at that here. But as you can see, coming off actually, not look too comfortable above towards 163, which we always thought would be a very strong resistance level. Obviously that was a high from the beginning of this year. We did reach we didn't quite reach that intraday high of 63.80. But we did get, really attempt to get into 163, and we just got a very, very sharp kind of reversal there. Now, in terms of, what's driving this, I think it's largely technical, but I also think it's largely to do with this, which is euro sterling, which has really pushed higher now. But it's up kind of over nearly had been as low as 83.50, so it's up now 100 pips, and really opening the way to that 85 level, which is the 50-day moving average. That's what's going to kind of be in people's view. Obviously, we did just have that, slight bearish crossover there of 50-day crossing the 200-day. If we can just continue, then that could reverse course, and we could actually, see some up thrust. Now, largely it's relative central bank policy which is driving euro sterling higher and weighing on the pound in general, and that's because obviously the ECB didn't talk down the euro and sounded quite sanguine on the outlook, whereas in contrast we have the Bank of England still banging on about forward guidance about how they're going to keep rates lower for longer. Of course, they probably want to do that because they may have been a bit concerned about the pound at these elevated levels. So, Martin, what would be the implications of the dollar and the yen if there is uncertainty around the debt ceiling? I would say a lower dollar yen. So I looked at dollar yen at the beginning, Martin. It's at 96.65 level. I believe that if there's increased uncertainty in the coming days, we could get below that level, which is the 200-day moving average, and that would be a very negative outcome that could open the way to 95. Okay. Sterling Aussie and sterling Kiwi have fallen quite hard too over the last few days. Indeed, they have. Sterling against the crosses has probably been one of the underperformers. In fact, we'll just take a look at that. The G10 performers, and as you'll see probably in the last few days, the pound has been one of the weaker performers. And that could largely be as well because it has indeed, look there, mine is down 0.17%, with the Australian dollar being the best performer. Now, partly that's also because we've just had such a good run in the pound. I think people have looked at cable particularly and have seen this kind of run up, over 10% increase there. That the minute we got towards 163, there was a wave of profit sellers. So this still looks like a bit of a pullback. We're still on an uptrend. But let me just draw this trend line here. Sometimes the technical analysis, a good old trend line really helps. So we're still technically in an uptrend. Obviously, life above 160 and we look good. If we were to get back towards 160, we're currently trading 161.10. To go back to that 160.35 level, we think that could attract some buying interest in the event that there is no resolution to what's going on in the US. But if there is, then we would expect the pound as well to come under pressure as the dollar staged a relief reversal. Softer numbers from the UK is also seen as presenting some weakness in the short term, but you're overall still bullish sterling. I mean, that's true. We did have a much weaker than expected PMI in manufacturing, but interestingly, the service sector PMI, even though it was slightly weaker than expected, it was overall, it looked fairly strong. With the UK economy is certainly not falling off a cliff. That recovery is still in place. But we do think that profit taking drove this, this move in cable because it's had just such a fantastic run. Other crosses, such as the Aussie, such as the Euro, are now playing catch up. This is Australian dollar, as you can see, looking very, very good. We have heard that there's rumours of very strong selling interest tonight at 94.50. That's just limited the upside so far today. Added to that, 95.50. So this looks like a bit of a tweezer top from here. But 95.50 as well is an important level. It's a rumoured barrier option. So if we were to get up there again, that could just attract some selling interest above there as well. But again, Aussie is going to be very sensitive if there is a relief recovery in the dollar. But it is looking like it's fairly well supported now, just below 93 at that 92.77 level, which is also the 100-day moving average. Euro yen also lower. Yes, well, Euro yen has been quite the volatile mover this week. Take a look at it here. I'll just shorten this time frame. As you can see, we had fallen to kind of a low of 131.50. We thought it would go lower because we had expected Draghi to talk down the strength of the euro, but he didn't, and that's what caused that sharp move higher. We then pushed all the way above 133, but again, that attracted some buying interest combined with that extra risk aversion. Remember, in a risk-averse environment, the yen is a big winner because it's a real safe haven currency. Let's take a look at Swissy as well. I am aware that I'm keeping you over the time limit here. Swissy yesterday passed a key level of support, which is this 90 level. Let's just go back to 2010. Look at a slightly longer term. As you can see, that is a massive level of support there. It's the bottom of the long-term range that goes all the way back to the end of 2011. We have had periods where we've gone below it, but we've always kind of pulled back. But obviously, if we were to get some sort of debt ceiling, hit the debt ceiling and that default to be a real threat, then we could fall much more sharply in dollar Swissy. So dollar Swissy, again, it's one of those safe havens. It's moving a lot at the moment. So do watch out for that. That was quite a bearish development by dropping below 90. We have managed to climb back above there, but the pullback has been very shallow so far. I just want to show it to you on my other chart as well. As you can see here, we are looking deeply oversold though. So a pickup slightly, potentially back towards this kind of 90, 70 level. These highs here from just earlier this week, that could be what, that could also trigger some selling interest. Black Cat, you've also asked an interesting question about the S&B, trying to talk down Swissy strength. Well, yes, I mean, they remain incredibly committed, to their Euro Swissy peg, which comes in at 120. Let's take a quick look at Euro Swissy. Any threat to that, and we believe they'll come in and defend it. But I think it's going to be very tough for them to defend, or try and weaken the Swissy in the environment of US debt default, because there at that point that's going to become a very attractive asset. Right now, yes, we fell to these lows just around 122, but we have remained supported above 122. So the fact that the euro is strengthening as well, that's helping to just prop up Euro Swissy. It's probably going to be some comfort to the S&B, and we really think that they'll only actually come in and talk down the Swiss franc if it relates to the Euro Swissy exchange rate, and that was to get kind of below 120, or say below 120.50. I think that's when they'll come out and say something. But I think they know themselves they're not going to really be able to support the tsunami of dollar Swissy selling if we do hit that debt ceiling. Okay, everyone. I'm happy to take one more question if there is one. Is oil. Okay, Rafiq, we'll take a quick look at oil. We kind of think, yes, that oil, again, the outlook for oil will be very dependent on US issues. Let's take a look at Brent, because obviously we're in the Brent trading hour. It will come up in one moment. Right now, we're just trading sideways. We're consolidating. We had those sharp drops, but we've been really in consolidation mode. Obviously, what we're seeing is some mixed data going on, which is really keeping oil capped. So whereas on the one hand, we've got this growth threat from the US, on the other hand, we've got a pickup in growth in Europe, which is good news, because Europe obviously being a major oil consumer. And then we also have of course, the prospect of more QE. So that's important. Wouldn't WTI be more relevant for the US? Well, yes and no. Overall, kind of, the Fed, QE has an impact on overall data. And I think no, actually, Gam. I think that, all oil will be impacted by what goes on. Because, Brent is just as much an impact there. And WTI is actually being, produced onshore now, with quite a lot of it being exported. So, that's kind of they're both going to be important. As you can see, moving very closely together there. I do want to show you something else though, because one thing you have touched on there is the difference between, or say the rate of change between, Brent and WTI. Let me just put this chart together quickly. Now this is a spread chart, so it really shows, NCL1. As you can see here, this is the spread between Brent and WTI. So as that was kind of falling down all the way into mid-July, it got to parity. So that meant the Brent and WTI were trading at exactly the same level. Often Brent has in recent years traded with a bit of a premium to WTI. However, WTI has started to pick up. So WTI has started to weaken. So Brent has started to get stronger, and that's why we've seen this spread just widen out a bit. So now Brent is trading with $5 premium to WTI. Partly that could be because of what you've been saying, that WTI is sensitive to what's going on in the US. Partly it's also been because of this pickup in growth in the Eurozone, as well. So yes, there are definitely different things right now though. This spread doesn't look like it's going anywhere fast, and the big move happened when we reached parity. At that point, that was unusual. So we've gone back to slightly more normal terrain, but we're still that spread is quite low. Remember back in February, we were, above $20. So Brent was trading at $20 premium to WTI. Okay, everyone, I hope that's been useful. Thank you all so much for joining. Again, it's a great, it's an interesting, fantastic time to be in the market. A lot of opportunity. Remember, whatever happens in the US, there's lots of opportunities. Could be kind of one of the ones whereby you have to hold on to your hats, but that makes it all exciting. Okay, so watch out for any of those stray headlines. Be careful, protect yourself if you have open positions over the weekend, because one stray headline coming out of the US could really change things. So we're in headline watch mode, go and have a nice long lunch because you don't need to be back in time for payroll. All right, everyone. Thank you. Bye-bye.